Let's bring in Shane Oliver, Chief Economist at AMP Capital. Shane, thanks so much for your time. How do you think the central bank will see these numbers today?
Well, to be honest with you, they were a little bit less than the central bank was expecting. The Reserve Bank and most economists like ourselves were expecting an acceleration to 3.5%. In the event we got a more modest acceleration, 3.3%, yet it's the strongest in a decade. I think it's also the strongest December quarter in a decade. There's always a bit of seasonality in this. So, I mean, on the one hand, yes, those numbers are consistent with stronger wages growth, but yet again, wages growth in Australia is sort of lagging a little bit. It's well below what it is in other major countries like New Zealand and the US, and it's a long way from being described as anything like a wages breakout. So on the one hand, it probably might give the Reserve Bank a little bit of comfort. On the other hand, their forecasts still have inflation going up, so I don't think it's going to stop them raising rates again when they meet next month in March.
So another rate rise, but maybe some reassurance that the moves so far are working, Shane.
There could be an element of that in here, that we are seeing some signs out there that retail sales have slowed down, that maybe the labour market's slowing down. Now we've got wages data, which is not coming in quite as strong as the Reserve Bank feared. So, yes, we're probably still going to see another hike in March, but it does put a bit of a question mark over rate hikes beyond that maybe the Reserve Bank might go on a bit of a pause, particularly if we see another round of soft retail sales and jobs numbers when they come out in the weeks ahead.
So looking at these numbers and everything else we've seen recently, the jobs rate, the broader comments from the governor at the parliamentary committees, is your read that it's a narrow path but a soft landing is still possible, or are you thinking a recession is likely now?
No, we think it is a narrow path. A soft landing is still the most likely scenario. But obviously, if the Reserve Bank continues down and follows up on the more hawkish commentary that it's had over the last couple of weeks, then that does increase the risk of a hard landing. But I guess the best outcome is that things cool off a little bit now. We continue to get some softer retail sales and jobs numbers, therefore the Reserve Bank, and wages numbers, therefore the Reserve Bank won't have to raise rates as much as they're threatening, which therefore reduces that risk of a recession. I mean, it's still a significant risk, but our base case remains one of a soft landing, although we would have to admit, as you just said, it's still on a narrow path.
And how does our economic circumstances, the inflation number, rates and so on, how are we faring compared to comparable nations internationally right now? I know rates have been rising in various developed countries. How does it sit as we speak this afternoon?
Well, right now, our interest rates are below rates seen in, say, the UK. They're above 4%. New Zealand, we just saw a rise today to 4.75% in New Zealand and the US. We're pushing around, I think, about 4.75% in the US, probably heading above 5%. And of course, Europe's down around 3%, but they've been lagging in all of this. They were slow to get moving. So on balance, we're in the threes. Other countries are in the fours. In terms of inflation, though, it is worth pointing out that we haven't had the surge in inflation you've quite seen in Europe, where it got to 10% or more, similar story in the UK. And of course, the US saw inflation go to 9%. We're still a little bit below that. So those things can be used to say, well, yes, we've got more to do. Our rates are still low compared to these other countries. But by the same token, it looks to me like our inflation has probably seen the peak. We do have a very sensitive household sector, and those things suggest to me that we're probably not going to get to the rates of interest we're seeing in these other countries, and I don't think we need to.
One of the difficulties internationally, we've spoken a lot about Ukraine war, but the COVID zero in China had a real impact in terms of bottlenecks for supply chains and so on. It looks like China might rebound more quickly than many had thought, and that has a positive flow-on effect for our budget and economy, Shane.
It certainly does, and it's one of the reasons why I think we will ultimately avoid a recession. If you just think about today, we got some construction data from the Bureau of Statistics, and it showed a fall in the December quarter. And you might say, well, that's going to be a bit of a constraint on Australian growth. But by the same token, net exports or trade look like they're probably going to add about 1% to December quarter growth. And as we look out through the year, that reopening in China will probably see their economic growth rate go from something like 3% last year, pushing up to 6% this year, which means ongoing demand for our commodities and strength in commodity prices, which I think will help keep the Aussie economy growing this year, albeit it's going to feel a lot softer than it was last year.